Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is, if you had one chart, just one chart, besides a regular chart of the S&P 500, as a way to understand the broad market environment, what would it be right now and why? So here is my one chart for today. So today's one chart is the S&P 500 using two key breadth measures, the percent of stocks above their 200-day moving average and the percent of stocks above their 50-day moving average. So when we talk about market breadth, it's essentially looking at price behavior and then using a measure of participation, which is what breadth really represents. To phrase another way, the S&P 500 in an uptrend, right, continuing to see a pattern of higher highs and higher lows. It's really been in a nice steady uptrend since November. Last time we sort of had this choppy period was in September, October, November of last year. Really accelerated to the upside, new all-time highs, and the S&P's continued relatively unabated in this uptrend. So what breadth indicators tell you is how many stocks are actually participating in that uptrend. Because a lot of times what happens is at the end of a move, as the market, a bull market is maturing, you will start to have a breadth divergence where you have breadth conditions weakening. And usually what that means is investors are getting defensive. They're still buying stocks, but they're getting into more defensive blue chip sorts of names, getting out of the high beta, small cap, more speculative names. And so it's more of the last thing that equity investors do before the market really sells off. And once things are, once you're in your defensive position, there's no more buying pressure, and the prices of the index and the overall market starts to go lower. These indicators here, this is the percent of stocks above their 200-day moving average, and it's using the S&P 500. So what percent of those 500 stocks are above their 200-day moving average? You can see here that the 200-day moving average for the S&P is indicated in red. And then in pink, we have the 50-day moving average. So the lowest indicator is the percent of stocks out of all the 500 S&P stocks. What percent are currently above their 50-day moving average? So if you look at the S&P itself, it is above both its 50 and 200-day moving average. And that's the case. But what you can see right now is 92% of the S&P 500 stocks are above their 200-day moving average. So 9 out of 10 in that condition. Only 2/3, 2 out of 3 S&P stocks are above their 50-day moving average. And that's actually down from about 85%. It's down about 25% since the last week in December. So what that tells you is about 20% of the S&P 500, about 100 stocks in the last 3 weeks have broken below their 50-day moving average. What that looks like is this. This is a chart of CSX, which is a railroad stock. You can see during much of this uptrend, it's above both its 50-day and 200-day moving average, which is usually what an uptrend, how it plays out. You have the price going higher, the 50-day moving average, and then the 200-day moving average. You can see now it's still above its 200-day moving average, but it is broken below its 50-day moving average. That happened a couple days ago. So, that would actually be one of these stocks. CSX would be one that is still above its 200 days. So it's part of this 92%, but it's broken down through its 50 days. So it's one of these 20% that's gone down. I mentioned breadth divergences earlier, and January, February 2020 are pretty good illustrations of that. You can see that this breadth line made new highs in mid-January as 2020 as the price went higher. As the S&P made its February high, though, you can see that the percent of stocks above their 200-day actually made a lower high. So we have a higher high in price, lower peaks in the RSI. That suggests internal weakness and really suggested there was increased risk of downside price movement. So why is that important right now? Well, we're starting to get a potential divergence here where you're starting to get, as the S&P is going to new price, so it made a new intraday all-time high today on Tuesday the 26th, but the percent of stocks above their 50-day moving average is sloping downwards. So while the index itself is going up, more and more stocks are actually breaking down through their 50-day moving average. And a lot of investors consider a pullback to the 50-day moving average as being a good entry point, a good time to add to an existing position if you long-term like the fundamental story. But this is showing that stocks are actually failing at their 50-day moving average and starting to go lower. So what does that mean going forward? So this is the early signs of a topping pattern. More often than not, you'll start to get some breadth divergences like this, where the price is going higher and these breadth lines start to roll over. Another common breadth indicator that we've talked about before is the cumulative advanced decline line on the S&P on the New York Stock Exchange, and looking to see if those roll over as well would be another key data point, looking for internal weakness or breadth weakness. The other thing to really look at is if and when the market starts to roll over, looking to see if these breadth indicators hold the 50% line. You'll see that in a uptrend, a lot of times they'll hold the 50% line, and that tends to be an encouraging sign. It means that the downtrend is probably not going to get that negative. But when you break down through the 50-day moving average, it tells you to expect a little more of a time. There's a little more of a correction that needs to happen, whether it's a time correction or a price correction or both, before the uptrend can resume. So at this point, it's an early warning, which is why it's my one chart for today. The price going higher, breadth measures starting to roll over a little bit. And the first one that makes sense is this one right here, as individual stocks start to trade below their 50-day moving average. If the market continues higher or stays stagnant or stays steady to the side, and this line continues to go down, I think that will speak to more and more internal weakness and an increased likelihood of a corrective move going into February. That's our one chart for today. Hope you all appreciate it, and wish you very best from all of us here at Market Misbehavior. Take care.